Richard Yetsenga, head of Asian Forex strategy at HSBC, joins us in Hong Kong today. Richard, talking about China, we're just less than an hour away from a big eco data on China. What do you expect? Will this data put less pressure on the yuan to appreciate?
Well, I think it's almost impossible for data at the moment to really reduce the pressure on China, at least from external sources and in fact from domestic sources as well, to move the currency. Whether GDP is up, 11 or 11.7 or 10.9, the point I think is that monetary policy is constrained by this, effectively a fixed exchange rate. And it's very difficult for China to raise rates and maintain this fixed exchange rate while US rates are so low. So, as I say, today's numbers, perhaps if they come in line with market expectations in the kind of 11.7% range for GDP, maybe add to the pressure in the short term, but the pressure's there regardless of today's data.
Timing of yuan appreciation is everything right now. You're saying if the yuan is not revalued in Q2, then it may not be revalued this year at all.
Yeah, I mean, I think let's use the term revaluation carefully. I think, we're not looking for any sort of one-off move of any material size at all. There are good economic reasons for that, but I suspect the political dynamic just means it's not possible. So we're looking for a return to the sort of gradual appreciation we saw pre-crisis. But the reason I think this quarter is so important is because the yuan clearly has become a more emotive issue both in the US and in China. And particularly with the US Treasury delaying the FX report, they've put themselves in a position where if China doesn't move the currency or start to move the currency, by the time we get around the strategic and economic dialogue in late May or perhaps by June, that will be 3 months after the report was due. It seems like they almost have no choice but to name China a manipulator. If they do that, I think the risks, of course, to trade tensions are pretty self-evident. And perhaps we need to take the currency off the table for this year with, I think, perhaps some pretty negative implications for all risky assets, not just currencies.
Richard, if China lets the yuan appreciate, will that prompt a revaluation of the Hong Kong dollar, you think?
No, I don't think so. I mean, if you think about, obviously it's nice to think about one currency versus another and China versus Hong Kong and the RMB moves and so the Hong Kong dollar moves, but in reality, the RMB's done all sorts of things the last 5 to 10 years and the Hong Kong dollar hasn't moved at all. So I think the way to think about the Hong Kong dollar is, really it's the exchange rate mechanism which still suits Hong Kong the best. Does an RMB appreciation perhaps introduce some more adjustment onto Hong Kong? Yes. But I think that adjustment is easily absorbed by the current exchange rate mechanism, so I wouldn't be wasting energy thinking about a change in the Hong Kong dollar peg anytime soon.
The Sing dollar, yuan forward strengthened after Singapore unexpectedly revalued its own currency. What do you make of the move? To what extent has it got to do with inflation expectations or expectations that China will let the yuan get stronger?
Well, the market's obviously drawn some conclusion about the RMB from the move that Singapore has done, and I think that's kind of natural. And I suppose one line of thinking is that Singapore generally only adjusts its currency twice a year. The next meeting's in October. If China moves in the intervening period, it puts some pressure on the Sing basket and so on and so forth. And I guess that's attractive. The other way to look at this thing, though, is that Singapore's GDP is explosive. They have revised up their inflation forecasts. And I think it's perfectly sensible from a domestic perspective, given what we know about the data now, for Singapore to have been reasonably aggressive. As I say, it's certainly led the market in the direction it wanted to go, though.
So is there room for further appreciation for the Sing dollar, though? And what other currencies are likely to do the same?
There's definitely more room for the Sing dollar to appreciate. To the extent that it was really only, in trade-weighted terms, it was really only constrained by the ban because of intervention by the Singapore authorities. It should, I think, move relatively quickly to the edge of the new band. If you think that the dollar also is broadly lower since Singapore made its announcement, that gives you more reason for dollar Sing to be lower. And also they've announced a move to a gradual appreciation, which of course adds some slope to the near band over time. So the Sing can do a couple of % more, I think, over the next week before we run into some constraints there. In terms of Asia generally, I just think the region looks very strong at the moment from a currency perspective, and really I would worry less about which currencies are not going to appreciate and really focus on the big picture.
Okay, Richard Yetsenga, head of Asian Forex Strategy at HSBC. Thank you.